This episode is sponsored by Lendlord. Lendlord is an online platform designed to help landlords and property investors manage, track, and optimize their real estate investments. Lendlord has a whole suite of free services, including a deal analyzer, property flipping calculator, tenant CRM, profit and loss reports, and so much more. I personally use Lendlord to track all my rental properties. Think of it as a modern day upgrade to boring old spreadsheets. Lendlord also has useful tools to analyze real estate deals, allowing you to calculate cap rates, IRR, and annual cash flows. It's completely free, so check out the link in the description below and let me know what you think. Hey, Saretsky here. Welcome back to this week's episode. Lots to touch on this week. We've got CPI inflation here in Canada. We've got an upcoming Bank of Canada rate hike set for next week. We've got some boots on the ground information of what's going on in the housing market. We've got national housing statistics. Going to walk you all through that. But I think it's important to sort of tee this week's episode up, really frame it up with the CPI inflation data, because the theme of the show certainly early on the inflation decelerating camp. It's kind of proven to be stickier than I guess I initially had expected. But at the end of the day, it is decelerating now. It's finally working its way through the system. Interest rates are finally sort of starting to obviously bring inflation down. So if you look at CPI, year-over-year inflation, headline inflation, I think it came in at below expectations. I believe it was 6.3% on a year-over-year basis. So we're kind of down from the low 8s, high 7s into the 6s. But again, this is, keep in mind, again, year-over-year base effects. So you're saying what was the rate of inflation compared to literally the same month 12 months ago. It is a backwards looking indicator. So I know that, the general public is kind of focused on that headline number, but if you kind of unpack it further, you can clearly see that we're making some headway on inflation. All you have to do is look at Canada's CPI on a 6 month annualized basis. This is a pretty good runway of information there. We're not looking at 1 month of declining CPI or 2 months. We're looking at a 6 month annualized data set here. Is Canada's CPI 6 month is running at 0.19% over the past 6 months, which is down from the early days in January, February, March of 2022. We're running at 12%. So we've gone from 12 to basically 0 on the 6 month annualized chart. So again, I know there's certain ways that you can sort of unpack inflation. There's certainly a cohort of people that, watch the show or comment on Twitter that are extremely upset about the idea that inflation can come down if the numbers are manipulated. And again, I'm just saying, listen, this is what's happening. I think we can all admit that, the days of those peak inflation scares, it seems to me like prices are stabilizing in many, many categories of our lives. And as they should. I mean, rates are up 400 basis points. People aren't spending as much money. New money creation. You look at M2 the monetary base, M2 money supply, it's actually in negative territories for the first time since 1960. So there's no question that inflation is now easing off. What was interesting most I found about this report was one of the largest contributors, again, still to sort of keeping inflation like a little bit stickier, was actually, again, shelter inflation. And everyone's talking about this big, Canadian housing bust, prices falling, and yet, shelter inflation is the stickiest component of the CPI basket right now. And part of that reason is because it's actually mortgage interest costs, which are actually pushing up the shelter index right now. So kind of rather ironic there, but again, interest rates working their way through the system. We know that shelter prices are on their way lower. And, there's actually a really good commentary, a little good interview here from CIBC's chief economist, Benjamin Tal. I think he's a pretty well-balanced guy. I don't always agree with all this stuff, but I think he's pretty well respected. And he had some really good comments on Bloomberg. So let's clip those right here.
Yes, because you really want to look not at the basis points, but the effectiveness of those basis points. To what extent the Bank of Canada is powerful and is able to deal with the economy. And if you look at back to 2008, the U.S. economy went through the mother of all deleveraging, if you remember. Mm-hmm. Their debt-to-income ratio actually went down. Ours, remember, this was not our recession. We were second-hand smokers back then. And our debt actually went up. So their debt went down, our per capita relative to income went up.
Right.
Now we have much more debt relative to the US, which means that when you start raising interest rates, you feel the pain in a more significant way. Not only are we more effective than the Fed, but we are also more effective than ourselves in the past. We have a chart, I think, that can show that basically looks at the increase in interest rates. Yeah, between 1987 and 1990, remember, those interest rates went up dramatically and led to the recession of the 1991. Roughly 600 basis points. So you can say back then, they raised interest rates more than today. No. If you adjust for the level of debt back then and today, actually back then, the 600 tends to be 300 in today's term, which means that the 400 basis points that we went through already is more significant than the significant increase that we have seen in the past that led to a recession. So I'm saying enough is enough. I'm saying we have to let the magic of interest rates to work before you raise again. I think the Bank of Canada should not raise interest rates again this week because I think it will be a mistake. I think that we are already starting to overshoot.
You think that they shouldn't, but do you think that they will?
I think they will. I think they will, and I think that they will go by 25 basis points. And I think they will go by 25 basis points because of the fact that the labor market was stronger than expected. We all remember we got 105,000 new jobs in December. That's a big number. And the Bank of Canada has to demonstrate that they are on top of it. So they will have to raise interest rates, although I believe it's a mistake. Remember, inflation is a lagging indicator. Inflation peaked a few months ago, and it will continue to go down. We will get numbers this week that will show that inflation is easing. On a month-over-month annual rate, it's actually going down dramatically. So inflation is really not the main issue at this point if you look at the trajectory over the next 6 months. But the numbers will not tell you that because inflation is a lagging indicator. And when you react to a lagging indicator, what do? You overshoot. I think that the next move by the Bank of Canada will be the beginning of overshooting.
Like I said, I agree with Benny here. I think that, the Bank of Canada goes 25 basis points. That was my call on the latest episode of the Loonie Hour. It's not necessarily because I think that's what they should do. It's more of like, what do they, the markets are pricing in 25. I think it makes sense for Tiff Macklem to go from that 50, dial back down to 25 and call it a day. But to Benny's point, it's like, let the interest rates do the work. I mean, the guys, all you have to do is look at Canada's National Housing Price Index, the home price index, the latest statistics that came out, down another 1.5% month over month. Finished the year, the National House Price Index was down 7.5% on a year-over-year basis. That's the steepest decline since the index was created in 2005. Again, that's on a year-over-year. But if you look at the peak to trough, you're down 17% peak to trough. So the index peaked in March. It's now down 17%. The national house prices are really coming down, and they needed to come down. I think everybody's in agreement to that. I mean, we had a clearly unsustainable housing market, but we're going. I mean, a 17% movement in 9 or 10 months is significant, and so the pain is not over. I mean, even if the Bank of Canada pauses rates at these levels, I mean, they're still elevated levels. People are going to struggle so long as house prices are flat to down, and there's an inability to refinance given the levels of interest rates, and because prices are not going up. So that's a painful sscenario. One thing I'd like to sort of point you to is the data on the national housing market. We've talked about this on the show before. While we do have a national housing market, not all markets are performing the same. There are a lot of micro markets. Every city is performing a little bit differently. So if you look on the year-over-year changes in home prices, again, Canada down 7.5%. Toronto, the worst offender, down 8.9%. I would argue that's where the majority or the most speculation has been. So you look at that, Toronto down 8.9%, and you look at a market like Calgary, which I have obviously been bullish on. I'm investing there, full disclosure. It's certainly a market that I have, been excited about. I've talked about on this channel over the last 12 to 18 months, up 8.1% on a year-over-year basis. Now, again, don't get me wrong. I think that the Calgary prices are going to decelerate. But, you look at that trade and you say, okay, well, one's down 8.9, one's down basically 9%, one's up 8%. That's a 17% spread there on prices. So congratulations if you played that trade. Selling Toronto and buying Calgary. The market, in my opinion, that will continue to perform less poorly, I should say, than the rest of the markets across Canada. But you really take this across all the major metros outside of Calgary, they're basically all in negative. They're all experiencing declines on a year-over-year basis. And so, I would expect that to continue given where interest rates are, even if the Bank of Canada pauses here, which I suspect they'll do at the end of this meeting here on January 25th. The pain is in until basically rates come down. And it's going to be a question of, where is, how deep is the recession that we get? How many job losses happen? I think that we have a structural imbalance in the labor market, which means you're probably not going to see as many job losses as one would expect. In fact, if you look at the most recent data, which we chatted about again on the Loonie Hour, is that there's still a whole cohort of businesses that are noting labor shortages. So people are really reluctant to let go of their skilled labor. So it could be, an interesting recession. Again, these things are obviously extremely difficult to predict, but that's kind of what we're looking at from the interest rate side, the housing rate side. We're, boots on the ground. What I can tell you anecdotally, what we're seeing right now, and there's been talks about, multiple offers in parts of the GTA and in Vancouver, is we have really low inventory levels right now. And that's pretty typical when you come out of November, December, and into January. People don't list their houses in the depths of December when it's dark and dreary out and people are gearing up for the holidays and half the realtors are on vacation, over in Hawaii and Miami, Florida. So this is pretty typical, but if you look at the overall level of interest of total inventory for sale, if I look at Greater Vancouver, for example, take the whole Greater Vancouver market and look at total inventory active on the market, it is incredibly low levels. These are levels that suggest you should be in a rip-roaring, massive bull market with double-digit price growth. Now, again, thank God that you've got incredibly weak housing demand that is actually allowing prices to basically flatline, and in some cases, they're still edging down, but they've really firmed up over the last 3 or 4 months, and that's because of inventory levels. So again, it's pretty hard to convince a seller to go and cut their price when there's no competition on the market. So if you're looking for the big housing crash here in Vancouver, Canada, that everyone's been calling for, you will need more inventory. And again, maybe that inventory is going to come. The next test is going to be in the spring market, March, April, May. But you have to understand, it does take time to build inventory levels. So even when you have really weak demand, it takes time for listings to sit on the market, to accumulate, for sellers to slowly begin reducing prices after they've been sitting on the market for 2 or 3 months. And so again, if you're looking for that, further downside in home prices, I really think you're going to be waiting past the spring market. So we're going to have to wait and watch and see how that plays out. But we need inventory levels to go up. I think that these levels are artificially low. They will go up. And so again, it's just a matter of how much are they going to go up to put downwards pressure. And a lot of that's going to depend on the path of inflation, interest rates from the Bank of Canada. You guys know my views. Certainly happy to be wrong on some of those. I think I've got a pretty good understanding of what's happening right here, right now in the housing market. Trying to predict 8, 10, 12 months out is always extremely difficult, but that's what this channel is trying to do, is to basically keep you updated on a regular weekly basis. So when the facts change, we'll be the first to let you know. So as always, hope that helped. See you next week.